My next guest says the report will cause the Fed to keep another rate hike on the table in November. Joining me now, Kevin Gordon, senior investment strategist at Charles Schwab. Good to see you.
Hey, Scott.
I mean, that might be the case, but it really does nothing to upset the narrative of what investors have been saying, or for that matter, really what the Fed thinks.
Yeah, I mean, I think it keeps it on the table in November. I'm not sure it definitively pushes that in the direction of a hike because, you know, as of now, if you were to just take the jobs report, the most recent jobs report, and then the CPI report we got today, I think there's enough cover actually in the jobs report to give the Fed for holding it in September. And if you don't get a continuation in some of the pops higher within the services category this morning within CPI, all of that combined, I think, would probably keep, a pause in September, maybe nothing in November. But it's too soon to tell. You have a lot of data to get to November.
When do you make a call? Do you think they're done or not?
I think they could be. I'm not sure one more hike matters as much. When you were talking at the opening of the show, that seemed to be a big debate. To us, that's not as much the focus as much as what the Fed signals from whenever they pause and whenever they stop.
I thought Steve Leisman, I keep calling him Leisman, Steve Leisman, made a good point earlier where he suggested that if they'd like to be done.
Yep.
And if they have to go in November, that's not a good sign. That means that it might not just be November, because if they see inflation data progressing to the point next month that they feel like, it's overheating again, one might not be enough.
I think that is the tough part, because if you look at actually all of the disinflation progress so far, or the disinflation that we've seen, most of that's been driven on the goods side, not as much on the services side. So given you've made that round trip with goods and it looked relatively transitory, I know that's a bad word, but the goods side looked transitory. Services has been taking much longer to come down, even if you take out the shelter component. So yeah, if there was a little bit of an uptick in goods, services took a lot longer to come down. The Fed somehow felt that they needed to adjust for that, all wrapped in under this umbrella of a tighter labor market. The good news for August was that you had a little bit of labor supply come back. There was a large boost. That's why the unemployment rate came back up. Mm-hmm. But if you still have relative tightness in the labor market and you have inflation hanging in there, then they'd probably be convinced that they just have to be a little bit more restrictive from here.
How's the market look to you right now? Seasonally, obviously, everybody knows who watches this that we're seasonally weak. We've been saying it a lot coming into the month. We've been saying it a lot now that we're in the month. What does that mean?
I don't pay as much attention to seasonals. I tend to focus really what's going on in the backdrop of this, and particularly for this market. We're just yesterday 11 months now off of the low from last October. I still find it remarkable that the banks are still down, that you really haven't had any participation from small caps. So to suggest that, from here you continue to do remarkably well across the market spectrum as you move down the cap spectrum, it's a harder argument to make because as of now, the September broadening out looked to be a little bit like a head fake. And particularly, I will say the one good thing at least is that it hasn't shifted back into just the mega cap trade. You haven't gone back to what you saw kind of in that May-June period where you had at one point a record percentage of companies underperforming the broader benchmark. All the leadership has shifted into the energy sector. But at some point, you're going to have to start seeing more of a convincing broadening out, especially within breadth metrics like percentage of stocks trading above their 50-day moving average, percentage trading above their 200-day, which throughout the summer now and the end of the summer has not looked very good at all.
I think it was yesterday where the B of A had their fund manager survey where it was overweight U.S. stocks in the survey for the first time in like 18 months.
Yep.
Emerging markets had taken a tick lower in the same questioning. What do you make of that?
I think it probably is in keeping with the growth differential that now seems to be emerging between the U.S. and the rest of the world. If you were to separate the rest of the world into blocks of the Eurozone and China, clearly China hasn't been nearly as exciting as people thought it was going to be this year.
Right.
That story's mostly known. I think on the Euro side, you've got heavy contractionary data in Germany. That's starting to spread throughout the rest of the area there. Even with the ECB still looking aggressive, and you have a little bit of differential working that way in favor of the euro versus the dollar, I think dollar strength right now is probably more synonymous with the fact that the U.S. just looks a little bit better than the rest of the world.
So you'd want to be overweight U.S. stocks as well?
No, I actually think in terms of U.S. versus international, the way we think about factors and take taking a quality-based approach and looking at characteristics like strong cash, lots of earning strength, lots of profit margin, and revenue strength, you can apply that across the world. So it's not necessarily a overweight the U.S. versus non-U.S. Because I think thinking too monolithically that way can trip you up in this market, whether you're just focusing on a single country or you're going across the world. But in general, I think that if the data continue to deteriorate in recessionary territory, true recessionary territory in the Eurozone, if that is the case, then you probably want to take a little bit more of a step back to view.
But your call on stocks has no bearing on whether the Fed is actually done or not. I mean, at some point, you're going to have to make a call.
Yeah, but I don't think anybody should be investing based on whether the Fed is done, because you go back in all of the tightening cycles, and when the Fed has been done, and you look at market performance for U.S. stocks, at least after that, there's an average, but the problem with that is that there's a huge range. So the best, if you go 12 months after the Fed has been done, the best has been up 30%, the worst has been down 30%. So you can't make a call and say, just because the Fed is done, stocks are going to rally. I've heard that a lot, and that really misses the analysis, in my view, of what the underlying picture is for the economy.